All right, welcome to Rich Dad StockCast with Andy Tanner. Today's show is going to be called Learn to Buy Stocks That Pay You Now. Wait for this part, and forever. That's pretty badass. So that's pretty cool. I do want to make sure everyone sees Andy Tanner, our resident. I'm going to call you expert because I think you're okay with that title.
The resident fellow student with everybody.
All right, you're a teacher today, though. Sorry. And hey, Andy, before we get too deep in this, I do want everyone to know Andy made a webinar for this title. And so I just want to make sure everyone can see that in the description. And I think you're gonna be amazed at what Andy's gonna tell you, and that you're gonna want to learn more. So make sure you go in the description, click on that. It's free, and just get a deeper understanding of what Andy's gonna teach us today.
That was one of the most I enjoyed that webinar as much. I just did it last night, and so the replay will be there. But it was we had such an active group on there. I mean, they were loving. So I kind of go a little crazy. So I just want to warn everyone. I ran a couple times and I go nuts, but it was a webinar. You know, a lot of people wonder, what does Andy teach? What does he do? So it's kind of a tryout for some of the people that were wanting to get in the Cash Flow Academy. So it's just kind of a heads up.
Very cool. So I'll try to get into the academy. I like it.
Yeah, it was kind of nutty, but I'll tell you, it was fun, and I'm excited for the topic today. We're going to talk a little bit about dividends with this, and there's other ways to get them paying you, like we've talked about options before, but I think it'd be great to talk. I think dividends are some of the most underestimated ways to get cash now and forever, like ever. And they're underestimated. People, I know what that is, poo-poo. No, they don't. Anyone that poo-poos those, they don't understand them. So dividends rock.
Let's go off the poo-poo comment, since that's hilarious. And again, we actually got this topic through the comments. So please leave a comment. Tell us how great Andy is. There's one comment in there that says how stupid Greg is, which is very heartbreaking, but not wrong. So, but please leave a comment on questions you have. This is how we got this topic of dividends. Is people wanted to learn a little bit more because Andy kind of sprinkles in a little bit about it, but really got their what's the word I'm looking for? Really got their mind spinning, and they asked to learn more. So we're reading your comments. We're glad to teach based on what you ask. So please leave comments. And one last thing, and then we'll let Andy, teach us and probably rant a little bit and all those things he does. We have to say this. It's not financial advice. This is Andy giving us education. Andy doesn't know you. I don't know you. We don't know what situation. We don't know your risk tolerance or even how much money you have to invest. Right. I can promise you Andy would like to know you. If he ever met you, he'd probably take you out for a beer because Andy's probably the kindest person I know, but he doesn't know you. So take this as education and not advice for you personally. All right, Andy, sorry for all the legal stuff. It's terrible.
No, that's not terrible. Actually, it's an opportunity. Whenever I see a disclaimer or I use a disclaimer, people say, that's just legal stuff. Get off of that. We know we're grown-ups. There's just involved. That stuff's really an opportunity to walk into investing with your eyes wide open. So I never gloss over that stuff, man. I think it's an opportunity to remind people this is for grown-ups for sure.
This is the real deal.
It's the real deal.
Let's dig into answer the question in the comments. Do you want to discuss what is a dividend before we dig in?
Yeah, let's start with real estate investors. It's an interesting thing because it's all about mindset. And if you look at a financial statement, there's three parts to it. There's the income statement where money goes in and expenses go out. There's assets and liabilities, what you own and what you owe other people. And then the statement of cash flows is kind of a tracking your bank account. You could have money come in there from loans. You could have money come in there from the sale of stock, or you could have money come in there from what we call operations, the stuff you do in your business. And so what happens is that creates several different opportunities to make money. For example, if I just look at it in terms of gaining money, I could buy stock low and sell high. There wasn't any work done there. The market just said, well, we think this is more popular than before, more demand for it, and price goes up. And I think that's predominantly where people land, unfortunately. It'd be like the analogy I give ad nauseum, but I keep giving it because the world fails to understand it, is, if you were to go and find the goose that laid the golden eggs, and you're to say, boy, I'll bet you if I buy that goose today, I'll bet you I could get more for it in a week. I don't know how to explain that to people. It's like, no, you actually buy the goose because the eggs is what you're excited about. I don't want to buy the goose low and sell high. Well, this happens in stocks. This happens in real estate, where people want to buy low, sell high, buy low, sell high. And that term buy low, sell high is not a way to get paid forever. I have a good friend who's just a dear friend, and he's got a business that flips houses, and he flips. It's kind of like redevelopment. It's kind of funny how people bash that. If you were a developer and you took some land and you put some construction workers on it and developed something and sold it, you'd say, I'm in development. You'd have prestige. But if you're in redevelopment, where you take construction workers and fix one up and make it look nice and update it, now you're a flipper. And he flips about 100 houses a year. But here's the thing: if he stopped doing that, if he stopped sending the construction workers to the site to force that appreciation, he would have no business. Whereas people can rent a house as long as it's standing, right? As long as it's standing. And so the idea of cash flow is a big one. So your question is, this big, and I'm making an answer this big. What is a dividend? A dividend is when we divide profits among owners. We divide profits among owners. And it is identical, in my opinion, to what we call a distribution. And I scream this at the top of my lungs when I go, the debate that I'm just ready to so tired of, because it's a pubescent debate. It's a my dad bigger than your dad debate. Is they say, well, what's better, gold or Bitcoin? What's better, commercial or residential? What's better, real estate or business, or stocks or real estate? And they think that success is the function of an asset class chosen, as opposed to the investor, who may be brilliant or not so brilliant. And so when I give money and invest in a syndication, which is a group of investors, syndicated, the profits that come out of that real estate project are distributed. So if we're all sitting around a table and, okay, you get yours and you get yours and you get yours and you get yours, we're distributing those profits or dividing them amongst the owners. It is the exact same thing with stocks. We have a bunch of owners, a group of people that each have a share of stock, and we divide that stuff. Someone will say, well, I have investments in, maybe a country club or 4 golf courses, whatever. Well, he may not own all of it. He may own a portion of it, right? But he does own them. He's got shares of that. Well, I own Coca-Cola. I don't own the whole thing, but I own shares of it. And so I have the right to get my share, and they're going to divide that up, and you're going to get a dividend. So that's what a dividend is. It's a division. It's a dividing up of profits. You're in business as a business owner. The goose lays golden eggs, and they pass them out to the owners of the goose.
So let me ask you a quick question, and maybe this is going a little too deep. And again, if you want to get really deep into this, click on the link in the description. And Andy, he has like, I don't know, an hour and a half webinar all about this that you can get for free. But when you say they're distributing the profits, are they distributing all the profits? Are they?
This is a great question. That's not a bad question. So what happens is there's something called a payout ratio, is the actual jargon, which makes sense. What percentage of money they pay out. And all stocks are different. If you go to Yahoo Finance for free, and you go to Yahoo Finance, you put in Apple or whatever, you can hit the statistics tab is where it is, and you can scroll down and it'll have dividend information. You'll say how much they pay out in a payout ratio. And this is really, really cool, because if you can see a payout, maybe they pay out, 30% of their profits. What does the rest go to? It goes to research and development. It goes to stock buybacks, which would be a really cool topic we should write that down. Mars, I got my producer Mars here. That's a good topic. We should do stock buybacks sometimes. They could buy back more of their shares. They can, invest, they could reinvest, they could do R&D. So if I see though that the payout ratio is not 100%, I actually say, okay, this is pretty cool, because if they fell on hard times, they'd still have enough money to maintain their dividend. They're not paying it all out. They have enough wiggle room there where they say, hey, look, we're going to take a portion and just portion these profits and pay these guys out. Or we'll do buybacks, which concentrates the shares, which makes the price go up. They can actually take profits and make their own stock prices go up by making them more scarce, less abundant, just like printing money or not printing money. You can print stocks or not print stock certificates. There's some cool stuff. So the payout ratio tells us, but here's where people, I don't want to steer our conversation too much, but here's where people screw up is they look at a small dividend. They go, oh, dividends, that's not a way to get rich. They do not understand how they work, man. They do not understand how they work. If someone sees a dividend and they say, oh, it's 3%, that's barely beating inflation, right? They're not understanding that dividends have a dynamic nature and they're not betting on inflation. So we could talk about that a little bit. Did that make any sense at all?
Yeah, but I do want to explore the payout ratio a little bit more, because when I first started investing in stocks, all I did was, I think I went to Yahoo Finance. They have a dividend tab there. And I didn't even look at the name of the stock. I didn't care. I just went to the highest paying dividend and bought that.
Watch out.
Yes.
That's kind of rough too.
Great.
Let's
so
talk
what is
about
it you're
that.
looking for? Yeah.
Well, let's talk about just finding the highest paid dividend. There's something called risk and reward. The higher the reward, often the higher the risk. For example, REITs pay out pretty big dividends. They're big dividend paying stocks. So some people try to attract investors. If I have a corporate bond and it pays a lot, they call them high yield bonds because they have a high yield bond. Well, that's a junk bond. So if you have a high dividend yield, does that necessarily equate to the quality of your company? No, it does not. So if a high yield bond is paying a ton of money, that means you're probably taking a ton of risk, right? So you'd love to have high yield dividends, but we want to do what's called a fundamental analysis on the company to make sure that the quality of work they do is really, really high, that they have a margin of safety, as Warren Buffett says, that they have unique things in them, like Coca-Cola has a unique brand and a unique formula. Be hard to dethrone those guys. They got a pretty big moat around that castle, right? Hard to dethrone those guys. Apple, insane brand. I mean, it's not really a luxury brand, but it's a high loyalty brand, right? They've got their tentacles in so many areas integrated in your daily life, your phone, your iPad, your computer, your Apple Pay, all your calendar, all those things are so integrated that they've got roots in people's lives, tentacles in there grabbing them. So there's a lot more to think about than just saying, well, I want the highest paying dividend. With that said, that's certainly a foundation that I look for. I only own I own Berkshire Hathaway that doesn't pay a dividend. There's a couple growth stocks that I think can grow and that I'd rather buy them low. And now here's something that's really important. Apple was a growth stock for a long, long time and didn't pay a dividend. One of the smartest things you could have done is bought it early. And this is what people don't understand. Warren Buffett bought Coca-Cola really early. He bought a lot of it in the 90s is when he bought a lot of it. And there's something called the investor yield is what I like to call it. His price on average for Coke after all of the splits that have been done is about $3.25. And I'd have to look up what the dividend is on Coke. I own it, so I should know. But I want to say the The dividend on Coke is probably around $1.60, $1.65, something like that, maybe.
Is that a year? A year?
Yeah, probably.
Okay.
So think about this. If you buy something at $3, if you buy a golden goose for $3 and it lays an egg worth $1.60 every time, that goose is paying for itself every 2 years. I mean, that's a 50%, pretty much it's over 50% on Buffett's money. So think about that. That's the way you want to think of a dividend, is don't think about where it is now. Think about how inflation will affect this, because if I really buy a stock, if that stock doubles, even if the dividend doesn't change, it's really, really important to understand cost basis. If that thing splits and splits and splits and splits, he's got more and more and more and more shares. It's pretty powerful. I don't like to make bets on where stock prices go. I'm not very good at it. I have guys on my team like Noah and Corey that are really good at it. I'm okay as a technical analyst. I think Robert gives me way much more credit than I deserve. He says, Andy, he's my trend guy. But I'm not as good as a lot of guys are at seeing trends. So I don't like guessing on stock price. But there's one trend I would bet on every time: inflation. Man, I would bet on inflation every time. The Fed, they'll have tightening like they've had. They've destroyed some currency, but they're going to go back to easing someday. The fiscal irresponsibility forces that. So if you are betting on inflation, think of this from a real estate perspective. What directions are rents going to go? If rents go up, profits go up. If rents go up, profits go up. Yeah, construction cost goes up, and management goes up, and insurance goes up, and taxes go up. But the fact of the matter is, if rents go up, profits go up. Well, the same is true. If prices go up, profits go up. And so dividends are going to grow most likely based on inflation. When I buy a dividend stock and I think about where that's going to be 10 years from now, the likelihood of the dividend growing is pretty decent, because it's a function of inflation often. It takes more dollars to buy the stock, therefore stocks tend to rise, real estate prices tend to rise, rents are a function of inflation. So we make more money. I mean, what a beautiful thing. Get yourself a property and you pay a price for that, right? And you get a fixed rate. Well, as rents grow, that profit margin expands. Well, the same is true here. I can buy a stock at that price. That's my price. If the dividend goes up, then I'm getting a better yield because I bought the stock 10 years ago. So people that look at the stock today, it's like looking at a little kid. It's like someone, it was funny. My son, Zach, was probably the worst basketball player I ever coached. When he was in the third grade, he's kind of lopey and he's tripping over his own feet and he's skinny. And, you go to catch the ball, his hands go like this and it hits him in the head. Can't throw it high enough to get to the rim. And a lot of the parents on his team, I coached because that's the only way he was going to make the team, is if I coached. That's called risk and control. If you control, your risk goes down. And so I helicopter dadded him, and I said, no, we're going to do this. And all these parents we're going to lose our coach. He's going to quit. His kid can't play. Well, now my son, he's the starting center for his high school. He's closing in on 6'9", and he's got muscles, and he's dunking the ball. I saw him not as a third grader. I saw him because I looked like that when I was in the third grade too. And I says, if he turns out like me, he's going to be throwing that thing down behind his head someday. That anyone who judges my son as being weak and small and they didn't see the potential. And the people poo-poo dividends the same way. Look at that little dividend. Look at that. Hey, you wait until where you are with that stock in 10 years, and you see how much that dividend freaking pays you as it increases.
Okay, that makes sense. Well, let me just interrupt you real fast. You're making a lot of sense how dividends really protect you from inflation, whereas a lot of times we talk about gold or Bitcoin doing that, but you're saying dividend stocks can do that. But I do want to go back to one thing, because I see money flashing in my eyes, right? I see this. Yeah. I see my greed button is coming out. I think I have a greed pimple on my head. I really want to hear, you mentioned the ratios, and I want to go back to that one time because the highest paying dividend might be horrible. I'm sure you don't want the lowest. So you have some ratio in your mind. And so as soon as we come back from break, I want you to teach the audience and myself kind of what it is you're looking for in a ratio. So we'll hit that right when we get back from break.
Okay.
All right. Welcome back to Rich Dad StockCast with Andy Tanner. And I made a quick promise to y'all before we went to break. And so I want to make sure that we keep that promise. Before we do that, make sure, like I said, this is just kind of an overview of how Andy teaches dividends. Make sure you go to the description, click on that link, and you can get a much more detailed, a much higher education with dividends. And we just want to make sure that we give you that offer. Andy, I promised everyone that we would go into the ratios that you're looking for with dividends because, like you said, the highest paying dividend is not great. I don't personally want the lowest dividend. So I feel like there's this area where I can buy these stocks and make a ton of cash.
That decision is based on a lot of different factors. And I think it really highlights financial education because what people want is not what reality is. If people listed everything they want to live forever, they want six-pack abs, they never want to get sick. I mean, it's just not reality, right? What we want. What people really want is a recipe. There's a little bit of that in criteria, but every stock is different. My kids are different, right? They're different from each other. They're both great kids, but they're different. Stocks are different that way. So when I look at the first thing I'm going to start with in choosing a company is, do they give value to the world? What work do they do? And what's the quality of that work? And I'd be extremely proud to be an owner of that business because I'm saying they do quality work. See, most people just want to get rich. They'll buy low, sell high. What's the price doing? They never ask about the quality. Well, the quality of the work is what gives it longevity. If you get a company like Apple, the quality of their work and products is just impeccable. That's why they can charge so much for them, right? And so the quality of the work or the food or the gasoline or whatever it is, that's where it starts. So after I get that, then I might say, do they pay a dividend? And if they do, I'll look at the payout ratio at that point, and they'll have a reason for why theirs might be 30% or 50%. If you're a pharmaceutical company, you got to reinvest in R&D. You have to innovate. You have to find new things. So, there are different companies, say them Procter & Gamble, right? Or Kraft Heinz that's making ketchup, right? There's not a lot of innovation. In fact, Coca-Cola is trying to preserve that formula. Every time they tried to tweak it with new Coke, it sucks. So every stock is kind of different. But I will tell you this, like ExxonMobil has an interesting history. I don't quote me. Someone can get in the comments and shred me for this because I don't have all this memorized. But my feeling is
that'd be fun.
They can. You got the engineer type of guys like, well, we're going to fact check this, and Andy was wrong. Well, welcome to the club. That's not exclusive. To be in the club that found I was wrong, that's not a small group.
Well, I want to read them in the comments. That's fun.
Yeah, but I will tell you, I'm going to guess that probably back from when I was in high school, 30, 40 years ago, whatever it's been. I think ExxonMobil has either maintained their dividend or increased it ever since they've put it out, at least for 35 years. So what that tells me is they're really committed. And ExxonMobil was really interesting during COVID. Talk about a resiliency test. No one's flying, no one's driving. Oil is negative. It's free, right? It's crazy. They're not making money when oil's free, right? Remember that? USO's going negative and all that. Yeah. And they're trying to get rid of it. There's no place to put it, right? So people are paying you to take it off. They're paying you to take the oil off their hands, right?
Right.
No one's flying. No one's driving. Worst. I mean, that's like the pandemic, the worst scenario you can imagine. I mean, that's worse than green energy, man. I mean, it's like free. Like there's nothing for oil, right? And they freaking paid their dividend and they kept raising it. I think it was probably 85 cents during COVID. It's 91 cents per quarter today. And it's incredible how like I'm saying, it's inflation, man. It's inflation. They actually went out. They were really smart. Exxon went out, and I wouldn't know the accounting. I don't know what happens behind the scenes, but I do know in the same period, I'm like, how the hell are they paying a dividend, right?
Yeah.
I mean, they have no money. You know what they did? They said, right now we can borrow money cheap because the rates are so low and everything's so low. We can borrow money cheap. They actually borrowed money and took that as an opportunity. I wouldn't even be surprised if they did buybacks. I don't know if that's for sure, but I know they paid their dividend because they're like, look, we're going to keep paying this. We're committed to our shareholders. We're going to keep paying them a dividend. And sure enough, when prices went back up, it was like, bam, no problem. So it was really interesting to see their commitment to their dividend and that it has been risen. That's a trend. Like most stocks, they go up and they go down. Theirs has gone like this. It just goes sideways or up. Their dividend has never dropped.
Wait, as an investor, that didn't trigger anything because now they're giving dividends not based on profit, which is what they're supposed to be based on. Now they're giving dividends out of what? Loyalty? Like, could you have looked at that and said that's bad management?
Come on, you're smart. Oh, wait, back up. Okay, what does Kenny McElroy do to pay his investors? You tell me right now. What does that dude go out and do to pay his investors? He refinances and borrows millions of dollars and hands it back to the investors. Right. So don't tell me that's out of bounds for an investor. That's all Kenny does, right? That's why Robert and Kenny love debt so much. Is they're in fact, the nice thing is when you pay that stuff out, there's no taxes on it because it's debt free, right? So the idea that an investor would borrow money and pay his investors with it, that's all Kenny does, right? That's his whole business. So yeah, that's not like a red flag. That's like a green flag. That's like, okay. That's the coolest thing ever, right?
Okay.
Isn't it interesting how an investor, a true investor, we just kind of see it through the same lens. Is it a dividend or distribution? The money's fungible. Let's say I get, I buy a handful of stock and I get like $300 a month average dividend from it. And I buy a single family home and I get $300, cash flow after paying get the rent and pay the payment and the insurance and the taxes. Okay, so I got $300 coming in from my dividends and I got $300 coming in from my real estate. Which one spends better? It's fungible. Both of them pay my cell phone bill or whatever. $300 is $300. And if I put in the same amount here and the same amount here, here's what's really cool about dividends. Let's say that I did this for you. And this is for all the people that are so enamored with, like, you got all the bot people that comment. I laugh at the bot people like, come buy my bit. Like they can't, their deal isn't good enough for them to go get their own site, their own stuff. They got to try to poach everyone from Richmond, right? Come by. This is really cool. There's just, it's like an idiot test, right? And you see it everywhere, and we just let it go. But the point of the matter is simply this: if you get caught up in this mired ooze of asset class, you're taking the focus off of the biggest factor, which is the investor, not the investment. I scream on that. That's a rant. I just fell into another one. I scream on this because everyone thinks it's about what you're investing in instead of who you are. Look, would I go into business with you? All these guys that comment that Greg's an idiot. Well, I know Greg, and I know he's not an idiot. I would never do business with you because I know, it's about you. It's not about your asset. It's about you. Would I invest with you? And that's the real thing with the investor. Now, I'll tell you something that's exciting. What if I gave you all of my shares of Apple in my will? I say, look, I bequeath to my friend Greg all my shares of Apple. So you have no cost and you have no risk because you have nothing in the deal. And I just give you my shares. And you get that dividend now and forever as long as Apple stands. It can be in your family trust and pay your children's children if Apple lasts that long. Anything wrong with that deal? So 5 years, so 5 years go by and I get hit by a cement truck and I die, and you get that in 5 years. Okay. That's like that's like an incredible scenario to have a free investment. It's like getting a free goose that's laying golden eggs. Okay. Well, what I did in this webinar last night is I showed people something called cost basis. And this is where people don't understand dividends. What if I can use option premium to pay for that in 5 years? See, the way Kenny would do it is he would like to refinance that property in 5 years with more debt and pay all the investors their money back through debt, through the refinance of debt, right? Yep. Well, so debt is how you use it in real estate. Options is your leverage in stocks. Well, what if you know how to write the right kind of options? Let's say you do the same thing. You get the entire, let's say you spend $50 on a stock, but through both dividends and premiums, you pay that stock off in 5 years. Now your dividend return is infinite because you're dividing by 0. So your dividend yield isn't 2-3%. Your dividend yield is infinity because you have to divide by 0. How much money do you have left in that deal? 0. So the only difference between real estate and stock is real estate, you can do it up front if you want by borrowing debt and equity. You're just at infinite at day one. Or some people buy it with cash and then they refinance. That's, you do that. Or you can collect premiums. Well, I'll give you an example. Like right now, I think I bought some Kraft Heinz, I don't know, it's maybe 6 years ago. I don't know, something like that. And I bought it with my business partner, Corey Halliday. And I asked him the other day, I go, what's our cost basis for all the dividends and all the premiums we pull out? He goes, I think it's like $2. So instead of having a $40 invest in it, I got 2. So I think the dividend's probably like 40 cents a quarter, probably like $1.60. So if you're spending $2, 2 something, you're getting $1.60. That's a lot bigger than 2 or 3%. That's why I say people don't understand. If I put you in my will and I say in 5 years I'm going to get hit by a cement truck and you inherit that free and clear, you have an infinite return. You put in 0 money and you get this the rest of your life, now and forever. As long as that company stands and pays that dividend, you get it. So people, that's why I don't think they understand the power of dividends. It's like not understanding the power of rent, right? That rent is going to come as long as the building stands. Buildings get old. I know that's why you have renovation. I know. But you can get paid. And that's why Buffett will never sell his Coca-Cola ever, because it's paid for. Like 1,000 times over, it's paid for. And he's just going to collect that dividend until the cows come home. I mean, his price on Kraft Heinz was $71. I think he paid for it. And then it gapped down to like 40. And it's just meandered there, right? Let it meander. I'm writing calls. I'm collecting dividends, paying for itself. I don't need the price to go up. I don't need it. It's like, hey, is the price? What's the price of your golden goose at right now? You see how stupid that is for people? What's the price of your golden goose right now? I don't know. I'm just watching eggs come out its hind end every week. I don't know what the price of the damn goose is. I know it's paid for itself. If I paid 10 eggs for the goose and it's laid 100, I don't know what the price of the goose is. I don't know. I don't care. I just want that egg coming out of that goose. And I wouldn't sell it if the price of the goose dropped. I'd sell it if it stopped laying golden eggs. It is a cash flow issue. And so you buy a golden goose, you get a little extra money from either debt in real estate or options in stocks, and you get it to pay for itself. Your cost basis is lower. It's awesome, man. It's awesome. So people look at a dividend, they think, well, it's only look, why do you think they pay them? Because they're attractive. People like them. That's why they pay them. They're there for a reason. So that's cash flow versus capital gain. That's just what it is.
But it's
I didn't mean to rant, but
you went into mindset quite a bit there, and I think the thing that triggered it is you were saying the investor is more important than the investment.
Amen.
So what you're saying is if you're the educated investor, you can see the greater investment that most people are going to miss, and you can see the value of a dividend that the average person is going to think is too small to even consider.
I mean, I imagine, I don't know the number, and I don't think Kenny'd mind if I talked about it, but I'm sure that he has a list of investors from Heck to Breakfast waiting for him to send an email to say, hey, I've got it. Are they doing that because they want to get a real estate? Or are they doing that because they want to go into business with Kenny? Is that an investment deal? Well, it's real estate. It must be good. No, it's Kenny. It must be good. It's about the investor. If Buffett calls and says, I have an investment, you don't care if you're, open up a tiddlywink shop or whatever. It's Buffett. It's the investor. It's Buffett. It's Soros. It's Kiyosaki. It's Robert. It's Kim. It's Kenny. It's the investor, not the investment. If T. Boone Pickens calls, I'm not going to say, well, oil and energy is too risky, man. Well, if T. Boone Pickens calls, we're in trouble because the late T. Boone Pickens. But if Buffett calls, you're answering the phone. So it's not about the asset class. It's about the cash flow. It's not about the price of the asset. It's about the cash flow. It's not about the asset class. It's about the investor. And hopefully that, why do I rant on that constantly? Why does it make me crazy? Because no matter how you ran on it, people they always, hey, what's the price of the stock going to do? What's the price of Bitcoin going to do? What's the price of the gold going to do?
Right.
And it makes you crazy. And it's because there is no financial education in school. That's why they don't know it. So anyway, that's just a tiny bit of the dividend. If you can get the 1-2 punch of a dividend here and a premium here, you've now got it's like having a goose that lays, double the eggs, right? It's like having a 2-headed goose that lays 2 eggs, or however that anatomy would work. I don't know, but I'm telling you, that 1-2 punch, a dividend on the one side and premium on the other, helps you pay for things faster. If you own it free and clear in 5 to 7 years, you got something that's going to pay you the rest of your life free and clear. That's an infinite return.
Yeah, that's making a ton of sense. We do need to wrap this up, especially since you're talking about geese with 2 heads and you're trying to punch your camera. We should probably just calm this down and wrap it up. But thank you. Thank you for the show. Thank you for the webinar.
Check that webinar out because it was so much fun. I'm a little nutty on it, so I'll just warn you, I get pretty excited. But we can actually draw these things out visually so people can see them better. So enjoy it. Enjoy it. It's free.
I'm going to watch it just to see if you draw a 2-headed goose.
I don't.
You don't? All right. All right, Andy. Thank you, and we'll see you next show.
All right, man.
All right. Have a good one.
Podcast is a presentation of Rich Dad Media Network.